and welcome to Montel's special webinar, The Energy Crisis, What's in Store for 2023. My name is Andrés Cala, and I will be your moderator for today in a discussion that will last between 45 minutes to an hour, and in which we'll explore what we can expect from power and gas markets next year. But just a quick reminder, please do send us any questions you might have for our panelists through the Questions tab, and we will try to fit them in during this session. But before we move on to 2023, let's not forget this year that is drawing to a close. It's been a remarkable year, to say the least. A quick flashback, markets were already squeezed last December amid low gas storage and geopolitical pressure ratcheting in Russia and Ukraine. On February 24th, the invasion started, followed by targeted gas cuts, and in the middle of summer, with the first Nord Stream cuts. That eventually led to a full stop, and before that, the pipes were sabotaged. In the meantime, power prices spiked, not only tracking gas, but also French nuclear woes. But Europe still managed to fill up its gas storage, and now, 12th of December, in the middle of a freezing cold spell, it appears the region will endure winter and 2023. How well is what we're here to talk about. How will Europe make it through the winter? And will we see power and gas blackouts? Could the market face a bigger supply squeeze in 23-24? How much structural demand destruction will Europe see? Will we fill up gas storage to the new targeted levels? And in the meantime, how will French nuclear generation behave in 2023? And lastly, are policy measures by member states in Brussels destabilizing rather than shielding market participants? Joining me to discuss these matters and much more, we have three top-level panelists. Nadia Martin-Wigan, she's a partner and energy analyst at Pareto Securities. A warm welcome to you. Ryan Alexander, research lead of European power markets at Aurora Energy Research. Nice to have you with us, Ryan.
Thanks, Andres.
And Wayne Bryan, director of European gas research in Refinitiv. Nice to see you again, Wayne.
Good afternoon. Always a pleasure.
So let's talk first about this year. I thought I would start out by asking each of you, as an introduction, if you had to summarize 2022 for a colleague returning from a year sabbatical in Bali, what would be the key takeaways that he or she would need to know to re-engage energy markets? Nadia, you cover the broader global energy commodity scene. How would you describe the tectonic shifts in European energy markets in 2022?
So I would start by saying that, in fourth quarter last year, as in 2021, we had a real run on energy demand. And that started with a standoff between Australia and China, Australia blaming China for COVID and then stopping buying coal from Australia. That then exacerbated into run on LNG imports, oil imports, where China said we must buy everything at whatever the cost, including raising coal productions within China. What happened over the course of this year is basically Chinese energy demand collapsed. So we had all of these supply issues that you mentioned, but on the demand side, we had the world's #1 oil importer, the world's, the country that was shifting LNG markets last year in the fourth quarter basically show negative year-on-year demands. In China, we think it's down 600,000 barrels per day year-on-year. We didn't have negative demand growth in oil in the great financial crisis. So it's very serious what has happened with these zero COVID policies. Same on LNG demand. When we look at imports, they're down 23% for the year. So thank God for Europe that happened at the same time when we've had these issues with Russian supply, which have, of course, hit the supply side into Europe, because that was 40% of of European demand, while we've had high coal prices and elevated oil prices as well. And we've had that maximum gas to oil switching. First, it was around 600,000 barrels per day last year. Globally, now we think it's up to 900,000 barrels per day. But the problem is there's not much more to give. So we're now sitting here in December We've had a sell-off in oil prices. We've had a much more negative thinking about what recessionary pressures. And, we have China announcing that they're out of zero COVID, but we haven't seen things recover the way they had. So the big question is, when will China recover? Are we going to see that 1.5 million barrel per day growth in oil? Are we going to see that jump back in LNG? So that's where I would say we are today.
And we'll certainly come back to that, Nadia. But Ryan, going back to you, to this fictitious colleague working out of Bali, coming back from Bali. What would you tell him about European power markets specifically? What lessons has 2022 left for us?
I'd probably tell them to stay in Bali, Andres, because it's been such a wild year, and the things we've seen in power markets are really just unprecedented, right? So we are used to seeing power prices of between 40 and 80 euros a megawatt hour in European markets, and we've consistently seen power prices 10 times that level, and that is being driven by a number of factors, but first and foremost, the massive explosion in gas prices arising out of Russia's invasion of Ukraine, and that predated the invasion, as Russia was turning off the gas taps to Europe, and we saw gas prices rise. That flowed through to power prices, and that's seen to different degrees, higher and lower levels throughout the year, but just persistently much higher than what we've seen historically. Now, gas still accounts for around 30% on average of European power generation. That figure is higher in some markets, like, for example, Germany, UK, Italy. And so in those markets, gas is setting the price more of the time. That's flowing through to higher average baseload prices in those power markets. And we saw a massive increase around late summer, early autumn, as a few factors came into play. And that was largely, again, related to gas markets. We saw the sabotage of the Nord Stream pipelines. We saw a lot of risk being priced in by traders who could see the writing on the wall, looking towards quite a depressing-looking picture for winter for power markets. And so that caused some stratospheric prices, pushing above 1,000 euros a megawatt hour in France, which has only settled down in recent days and a couple of weeks. And the only other thing I would add to that is that this has been exacerbated by other factors which aren't related to the war. So much lower than average availability of the nuclear fleet in France, lower than average hydro reservoir levels across Europe, but also quite pronounced in, for example, Spain and the Nordics. And all of that has contributed to what I would call a perfect storm this year in power markets.
Quite a summary. And how about you, Wayne? What would you tell this fictitious person specifically about gas markets? How did gas trading change in 2022?
Well, it has been a crazy year in terms of the gas markets. And I think some of the points covered by Ryan there covered some of the gas market, or most of what's been happening, really. But I think the first thing I'd say is stay in Bali, where heating prices are obviously cheaper than they are in Europe right now, especially I'm here in very cold London. So in terms of the gas market, I think what you want to look at is firstly the sort of reconfiguration. Gas is now flowing not from Russia as it used to be. We're seeing a lot more from America. So I think firstly, looking at how the market is reconfigured, and I think don't trust the Russian in terms of the supply. We've seen that as well. We've gone from over 40% reliance on Russian gas. Obviously, we're using probably about 6 or 7% of it now, we're importing. So I think the key takeaways have been firstly changing. So we've gone from this, relying on Russia for many years now. We've now moved that reliance actually to USA. And we're now seeing, obviously, a huge ramp up in LNG cargo arrivals into Northwest Europe and Europe as a whole. We've seen the UK help fill German and Belgian storages by way of the UK having such a large import capacity. So we've seen another reconfiguration there. And we've seen a lot of different, how can I put it, sort of geopolitical twists in terms of we had ruble payment saga. We had the Nord Stream turbine that was to-ing and fro-ing from Canada to Germany and back and never quite made it to Port of Royal compressor station. Then, of course, we had the sabotage on those pipelines as well. So there's been a tremendous amount of, say, turbulence on these markets. And now we sort of move into the winter again. And I think now, firstly, we're seeing strong levels of demand. We're now worrying about how we're going to manage. Of course, storages are full, but we can drain those storages quite quickly. And I think the latest thing we have now is the latest EU policy meeting, which I think is tomorrow, where we're going to discuss price caps once more. So yeah, it's just been a real whirlwind of a year. And having traveled around Europe quite a lot, spoke at a lot of places, spoke to a lot of people, I think we're all looking forward to the end of this year and moving into next year. But that doesn't mean the challenges won't still be in place. And I think for me now, the concern is getting out of this winter, but not only that, but what happens next year. And I think first we concentrate on this winter, but for me, there's a lot of risk ahead going into 2023, even more so when we see conditions like behind me and around the rest of Europe at the moment. So lots has changed in the gas market, but the main thing is the reconfiguration of it, and also as well, stronger demand or stronger gas for power demand, weak wind, more generation from coal. So yeah, there's a whole plethora of things have changed really.
Well, you know what, you hit the nail right on the head, Wayne. And if I can stay with you, and we can start discussing present and the current market balance. First of all, we can talk about demand, which obviously means, to start with, weather. Cold means more power and gas demand. And the latest forecast for December point to freezing cold temperatures for most of this week, slowly
Correct.
rising to normal by the end of next year. So what can you tell us about this winter and the latest forecast, Wayne? Also in Asia, as weather there is critical to your supply stream.
Yeah, first and foremost, I think what we're seeing now actually is quite interesting for us here at LSEG or in the European gas team. And I'm sure many traders, analysts across Europe are the same, but we're now getting some real proper data, like cold weather data. We've seen this previous cooler weather, but we haven't really seen like a real, test or real severe winter conditions, which is what we're experiencing now. So I think these data points over the coming month or so will, and I've been talking about this quite a lot. I mean, we all talk about demand destruction and we're seeing some elements of demand destruction, but I think the main thing to consider as well is, as we know, residential demand is the strongest. Now it's cold. Are people going to worry about their energy bills and perhaps turn their heating down a notch or two, or not turn it on in some cases for those that are less fortunate? And there are quite a lot of them across Europe. Or is it a case of, okay, it's cold, I'm getting colder, I just want to be warm, let's turn my heating on? So that firstly is a kind of interesting balance to see how that plays out. But again, this next month or so will give us some valuable insights. So that's, in terms of the weather now, it's playing a really important role. And you saw that October was warm. We saw one of the most warmest Octobers on record, and that sort of lulled people into a false sense of security, I think, especially some of these headline makers. Storages are full, we're going to be fine. That's not the case, and you're seeing now the strong levels of withdrawals that are happening across Europe. And I think now what we need to be concerned about is, will this cold snap develop? Will it get colder into Q1? There's still a lot of risk in Q1 for me. You mentioned Asia. Asian weather is important too, but don't forget Chinese demand hasn't recovered yet. There's talk of COVID relaxations due to the recent protests, but how long does that take to sort of, translate into increased demand from whether it's the economic sector rebound or even from domestic players? So there's quite a few, still a lot of uncertainties remaining, but weather now really is the key. And we mentioned these weather forecasts, and there's a lot more attention than usual being given to these weather forecasts now, like 45-day, the GFS 35-day, etc. So I think we're paying a lot more attention to those. And I think that situation is sort of given us, before we always took a lot of, we took a lot of interest in these weather forecasts. But in the current situation, this market is so delicately poised and delicately balanced. Whether it's extension of a cold weather or supply disruption will really exacerbate the price movement. And you can see a lot of risk is priced into the curves at the moment. So yeah, weather, very important to how we navigate the remainder of the winter, because we've got off to a very good start. Let's not forget that. But we're far from out the woods yet in terms of the rest of this winter, and these next month, 2 months will really shape how we go into next summer, which will, of course, lead us into next winter as well. So,
Indeed, and that ties directly with another one of those good barometers, so to speak, of the energy scene. Nadia, if we could talk about replenishing gas storage for 2023. Can you paint us a picture on what is at stake with storage refilling this year? And what are the challenges ahead to make sure that by next winter, next December, storages are also almost full?
So we had the EU decide to really push mandatory storage, right? And the level was supposed to be 80 to 90% full even. And then we overshot that number of aiming for, say, 80% storage full by hitting above 95% full, right? And that building really came in the summer already when power prices and gas prices were super, super high. And I think this has been part of why in the shoulder season, where it's been quite warm, as Wayne was saying, we've continued to actually not draw down on storage, relatively speaking. And we've continued to have massive record LNG shipments coming in. And I think, we've, by having this mandatory storage level, we've almost introduced potential moral hazard into the market because, traders who bought gas and LNG at those levels, they don't want to close out that trade at a loss now. They'd rather actually bring in more LNG. And I think that this is problematic next summer if we've drawn down the storage a lot. And Wayne is talking about how already now in December, we might be at the start of the change. The biggest issue come March. April. Is it a long winter? Because as you draw down storage, you lose efficiency when it drops down lower. And so that is the big question. And when you have this memory of what happened this summer, you might be more cautious. So what I worry about is that we'll see slower rebuilding of storage as we approach, September, October, November 1st deadline. And then there's that massive rush. And especially because we have so much more LNG import capacity coming online through FSRUs, that it's this idea that, okay, we can do it later on. And that's where I think that can create a lot of volatility and tightness next year heading into the winter.
Yeah, in fact, the European Commission says it wants storage at 45% full by 1 February and to 55% if it's a mild winter. Is that even doable? I mean, can we realistically expect these levels? I'll just say a normal winter as our entryway.
Well, I think physically, it depends, of course, on the weather. But, so right now, if things were the way they are, then yes, it is possible. But I think it introduces a lot of volatility into the market because, you're trying to control storage levels instead of having these main, concern, the main market dynamics. And I think that's very, very tricky. And when they talk about price caps and things like that, I think it just creates a lot more uncertainty overall. But it is doable. But it's tricky.
Well, when it comes to demand, and this, I'll leave it open to the floor. Demand, and I'm talking about gas demand. It was down 23% down in November, 11% down year to date on total demand. That's for EU, and according to Bruegel think tank. The question is this enough? And the sector stats on that is industry has come down 25% in November, 15% year to date, which the same numbers for residential. Maybe Wayne, you can start us off. The main question is this enough? Are we on track? I don't mean to meet European targets, but is this enough to balance markets?
Yeah, well, you say about this demand destruction, but some of that is quite distorted, as I mentioned earlier. This demand destruction we're talking about has come about through a couple of different measures, not just some of the EU measures. We're talking about the weather's been extremely mild. We're talking about high prices forcing certain producers out. So that's another thing that's kicked in terms of demand destruction. But like I said, I think what we're going to look at now over the next month or so is how much demand destruction is actually, can we expect when the weather's like this. And that is key to it, because you mentioned industry, but residential consumption, as we know, is the biggest driver of consumption. So the industry might slow down a bit, but we're more worried about what's going to happen in terms of on the residential side, who we are the biggest users of gas. And when you say, will it be enough? That's a hard question to answer at present, because like I mentioned, it's like we're spinning plates at the moment. And if a couple of these plates fall off, that won't, 50% demand destruction would not be enough. So it's a hard thing to judge at the moment, but I think as we get through the next sort of month to 6 weeks, we'll have a lot clearer idea. And I think the message probably hasn't been strong enough as well in terms of from the EU in terms of demand destruction. I see there's some speeding up of that now in terms of media campaigns in certain countries, etc. Turn down your thermostat, all the rest of it, but it might not be enough. And again, it's because we've left ourselves in this vulnerable situation where we relied on one supply source for so long, and now we're using an abundant. Well, say we're using different supplies now from different sources, and we're really stretching. We're really going to be stretched, and we're assuming everything's running. And I not even mentioned French nuclear. I mean, that again is another big uncertainty. We're above 40 gig now, I think, for the first time since March, and even when you say that since March, it just sounds crazy that they've not been able to get above that level since March. And we've still got, I think, 16, 17 reactors offline at the moment, some slated to come back online by the end of the year. Will there be further? And that whole changing of the power, and I think we'll hear further on that, but that changing of the sort of French normally being, the major exporters of power, now they're struggling. They're looking to get power from everywhere. So there's a raft of things, but the demand disruption, will it be enough? Only time will tell, but I think we'll need to see more of that.
And actually ties in also, Ryan, with the next question I had, which was about the power sector. I mean,
yes,
will we see demand destruction in the power sector in 2023, and a lot, and starting with this winter? After all, France is more dependent on electricity for heating than Germany. And several countries are in the same boat. So what do you foresee for the power sector in terms of demand destruction in 2023? And also, French, the uncertainty over French nuclear generation.
Sure. Well, yeah, indeed, there's, demand destruction takes place in a couple of different ways. It can be voluntary, or you can have your power turned off. And I'll come to the second one in a second. But in terms of voluntary demand reduction, so we've seen a decrease this year in power being consumed. So what we've seen the last time we ran the figures, which was in August, that there was a 6% reduction in power demand year on year across many European markets, and that varied depending on the market. Why is that? That's, at least from our perspective, a direct response to the massive increase in power prices. So it is just price elasticity at work. The prices are high, people reduce their consumption. And if you ask the question, well, is that going to continue through to next year? Well, the answer is it depends on power prices. Now, that then depends in turn on a couple of things. So I guess we'll talk a little bit more later about how power prices might evolve into next year. Certainly, if you see the triple-digit power prices that we've seen throughout this year, especially if you're talking about 500 or 600 euros a megawatt hour rather than 200, then you see the effect of that on power demand pretty clearly and across multiple economic sectors. Now, the other part of the demand destruction equation is rather when it's mandatory. So you have blackouts, and well, it's been also a wild ride there in terms of how the past couple of months or few months have evolved. I mentioned a bit earlier some of the factors that drive the supply-demand balance for power this winter, one being French nuclear availability, as Wayne was referring to. And on that one, indeed, I mean, it is great that we've seen, I guess, the French nuclear fleet hit this psychological threshold of 40 gigawatts of availability now, which is good to see. But it's also important to note that 2 or 3 or 4 months ago, their projections were aiming for about 48 gigawatts of capacity online by this point. So, I guess my take on that would be that it's not to say that we're in great shape now and there's nothing to worry about, but we've avoided the worst case scenario, let's put it that way. Now, and that's also reflected in the market. So I mentioned earlier, we were seeing contracts for power in France in January, baseload contracts at pushing €1,000 a megawatt hour. And over the past couple of weeks, that's dropped way back off. And I just had a look before the call, and they're at about €500 a megawatt hour now. So, we're starting to see, I think, a bit more optimism in terms of how the risk of blackouts look in France, at least for the coming winter. But that's not to say that they're entirely out of the woods. Now, this is also a picture that's repeated across other markets, right? So ENSOE, the European Association, came out with their view of security of supply over the coming winter. And so there are risks in also not just in France, but also in southern Sweden, in Finland, Ireland, to a certain degree, Poland. Now, these all come up or arise for a variety of factors. And it's also, just to say, it's also Great Britain. I think the latter example is quite interesting because in Great Britain, they have quite a big proportion of wind providing as part of their generation capacity. And so it's not just a case of, is the nuclear fleet in France available and exporting power to the UK when it's needed? It's also a question of how windy is it. And so we saw some quite low wind days in the past couple of weeks, and that actually has impacted on the GB power supply-demand balance. So, it comes back to this idea of a perfect storm over the coming winter. So I would say, yeah, it's quite a mixed picture, but it's certainly better than it was a couple of months ago.
Will we, and to stay with you, Ryan, but will we see more coal burn in 2023? Considering I know we still need more clarity on what's going to happen as a hydro year, because we're only starting the rainy season. But is there? How do you foresee coal burning in Europe next year?
Sure. Well, we've seen already a pretty substantial gas to coal shift in the power sector over this year. So the stratospheric increase in gas prices has made coal more marginal and really increased coal consumption over the course of this year. And so certainly, if you take the view that gas prices remain elevated, coal prices have also gone up too, but just not as much as gas prices. So if you take the view that gas prices do remain elevated, then that dynamic still remains there. But I think what's important to flag is that there are some limits there, and I think we've seen pretty substantial shift in fuel switching in the power sector. I'm not sure how much more we will see because utilization rates of the coal fleet have increased so much in the course of this year.
And lastly, to stay on power, we had, and correct me if I'm wrong, a record year in terms of renewable capacity additions in the European Union. Is this to continue or to even hasten next year?
Yeah, that's a great question, and that's because indeed it is a success story that kind of went under the radar, right? We're pushing above 30 gigawatts or so of installed capacity across Europe, and the average was, something a fair bit less in prior years. So there is a positive story there. But the thing I would flag is that there are also issues that are well known in the power sector in terms of maintaining, let alone accelerating, the pace of deployment of renewables. Permitting, grid connections, that's pretty constant across many countries. The fact that wind OEMs are getting squeezed, their margins are getting squeezed, and the wind sector, as it is, at least the manufacturing sector, is not a particularly healthy one at present, as well as the supply chain crunch that we've seen coming out of COVID, and we see that flowing through to the raw materials prices of key inputs into renewable technologies, so polysilicon for solar, as well as lithium for batteries, as part of the broader renewables piece. So that's decreasing. It's making for a less healthy investment environment for renewables this year. But you would have to hope that that's a transient thing, because those markets will correct themselves, and we should only see a blip and certainly not any long-term damage for renewable investment prospects.
Okay, well, no, thank you, Ryan. And if we turn back to gas, Nadia, This is, I guess, the $1,000 question, right? The top question. Do you expect, and if so, when a Russian stop to European gas supply to Ukraine?
I mean, I would say the market in general expects it to completely stop. That is more of a matter of time when it happens. It's a relative question. I mean, we have blackouts across Ukraine going on constantly. You get electricity for an hour in a few days. In Odessa and places like that. So it's the gas question. I think, given the assault, the market assumes that it will be cut off, and I think most of the forecasts assume that. It's been a very small amount going through Ukraine up to now. But I think if we also think of that in terms of, the demand question and how we see things for next year, the IEA, for example, thinks that European gas demand should fall 10% again for next year. We find that very difficult to see. We think we could see a max of maybe 3 or 4% without things really getting very, very tough beyond this year. And that is also assuming that some of this residential switching is actually sticky. People get used to having slightly cooler temperatures and things like that because prices remain elevated. And, when interest rates are going up and things like that, even if the absolute price isn't as high as we saw, it's still relatively, a bigger chunk of a smaller pie, or at least as big a chunk of a smaller pie. So I think that is something that we struggle with, seeing how much more demand destruction can come without, really impacting things quite negatively. But then when we look on a global basis, we expect, the shortage in gas to be 30% greater versus this year in our balances. So it is and that is, of course, because we believe China is going to have a strong comeback over the course of next year after abandoning zero COVID. And this is where that timing and understanding is so important, because we have to remember China has the long-term contracts, not Europe. We're buying off the spot market. Chinese spot market buying has basically collapsed. And so that has made everything available. And because Europe is still not willing to really sign these long-term gas contracts. Yes, they've done a little bit with Qatar, but not with the US to really build up that machine on exports, not even with Norway. So it is where I think it is very tricky on how we are going to fill that if and when China comes back.
But even Nadia, even before we move into LNG, which is such a critical part of this conversation, of course, any conversation regarding European energy. But on the pipeline side, do you have any outlook on the other pipeline? I'm referring to Turk Stream, Algeria, as flows from Azerbaijan, even Norway. I mean, Norway has been producing some days at 330 MCM, and we already know they're going to need more maintenance time next year. So how much more can we get from pipelines?
So starting with Norway, as I sit in Norway, we have seen more than 5% additional gas flows coming from Norway, and we do have maintenance coming. But part of what Equinor has done, for example, is that they've stopped doing their usual gas injections in certain fields so that they have additional gas to send to Europe, and some of that gas goes actually all the way to Ukraine. So I think that versus the industry, we're actually less negative on what Norway will bring. We think it is actually possible for Norway to be flat year on year. I think the industry expects it actually to fall back to where it was pre this crisis. I'd say Azerbaijan, we see, maybe like 1 MCM per day additional coming forward. Same with Algeria. We're not talking about massive amounts changing on that part. So it really is about that pipeline flow. I mean, sorry, the LNG flows rather than the pipeline flow.
And indeed, but even before that, what about your outlook, Wayne? Do you see Russia cutting our gas, the European through Ukraine anytime soon?
Yeah, I mean, we've run a couple of our scenarios, including Velké Kapushány and without Velké Kapushány. And I think, as Nadia alluded to, I think there's probably still some risk premiums lingering in some of these forward contracts. And I think most of us in the market expect it to happen at some point. I probably would have thought it might have happened a bit earlier, but we're still seeing flows through the pipeline. But at some point, we do believe, these flows will halt. And I think if you step back a bit and we talk about the wider situation, I think even this morning, and they've mentioned it before, the IEA have already highlighted the concerns for next year. And like Nadia said as well, we've got to worry about next year because we haven't got that Russian gas that's going to help fill the storages like it did this year. If we see a resurgence in the demand from China as well, and if we have a summer even close to as disrupted as this summer was, in terms of the hydro situation, in terms of all these high temperatures and extreme strong demand, then we could have another big supply shortfall. So as much as it's quite small volumes, they're still reasonably significant in the wider picture. But at the moment, these flows are still coming. But I won't be surprised if we're sitting here in a few months and these flows have halted. Because they know what they're doing in terms of, say, they're Russia, the Kremlin, whoever you want to attribute, in terms of the squeeze on Europe, and we've seen what's happened with inflation, etc. This is all come from one thing, and that is the slowdown or the complete, more or less, halt of Russian gas flows into Europe. So,
so it all comes down to what Nadia was alluding to earlier, which is, of course, LNG. We've had November was a record month, a historic record. I was mentioning earlier in the private room that we hit another record last week. Last week was the highest monthly imports of LNG Europe has had in history. And so it just foreshadows that perhaps December we might hit a new record. And a lot of this is also, or we can expect it to increase on the additional capacity. We have 4 BCM capacity FSRU coming already online in Eemshaven. Another 4 BCM will be connected sometime by the end of the year. We have 7.5 BCM FSRU in Wilhelmshaven also coming online this month. Later this month, we have more LNG capacity in Germany, and throughout the year, more FSRU capacity. And all of that is all well and good. But of course, the key aspect Nadia already alluded to is, we've been importing, Europe has been importing as much LNG as it wants to, as much as it can fit, according to its send out, of course, not to its nominal capacity. But we've pretty much been unloading as much as we want. We even had a flotilla waiting around for 2 months, just waiting to unload. So the question is, at the end of the day, because Asia at some point will come back, as Nadia said, when do you expect this? Nadia said Q1. Do you have any outlook, Wayne?
Sorry, myself, in terms of, I agree in terms of Q1, it could be, but I think it might be slightly early for Chinese demand, as I alluded to earlier, just to rebound so quickly. Yes, they're going to relax some of the curbs, but to get back to the sort of levels we expect this early in the year, I don't see it happening, but later on in the year, for sure, as we get into Q2. And of course, if the weather does turn, and that might raise imports as well over Q1. And we saw that happen last year. I think towards the end of December, we saw prices really rally on the cold snap in China. And of course, the concerns of the buildup of Russian troops on the border of Belarus and Ukraine. But I think what we'd expect is some uptick in demand. I think Gale as well have asked their guys to actually import more LNG so they avoid what happened last summer in India in terms of the power shortages. So weather turning, some additional spot demand, and then Europe could see less imports. But if you look at last year and probably before, we saw a ramp up in imports later into January, Feb, and the markets then sort of collapsed before then the invasion started, of course. So there's a couple of things, but I think what you said, you highlighted this, it sounds fantastic. FSRUs here, additional capacity here. It all sounds great, but where do you get that gas and at what price do you get that gas? And who is going to not purchase that gas to allow it to keep coming into Europe? We can't keep thinking that China's demand is going to remain, subdued for much longer than probably out after Q1 or towards the end of Q1. So,
Well, you know what, Wayne, you mentioned the rally last year when China went out into the market, but I wonder if, and this is a question for both you and Nadia, if we could have a similar instance, but not driven by China only, but the fact that we're going to be all this capacity we're adding in Europe just means more intra-regional competition. I mean, German companies will be competing against French, against Spanish, against UK, etc. I mean, and that just drives up prices. Do you foresee European demand being the catalyst of another price rally? One analyst told me a couple of weeks ago in Athens that they expected he expected record prices this year, higher prices this year. Due to intra-regional LNG competition. How do you two foresee this?
If you want me to start, Wayne, I think that part of this, goes back to what you were saying about these storages, right? If they're going to push storage building in the winter, in the spring and February, and start a price rally when prices should be high, and then you get this kind of competition, I think you can have that kind of disruption, especially in Wayne's scenario where he believes that, the comeback in China will be, ups and downs, and which makes a lot of sense, right? We've seen it in the cold season in Norway that, after being relatively locked up, nothing like the Chinese or the people in China have experienced, you do get more illness. So I think in that regard, we could start a bit of a price rally, but I think also in the case of China, there's a difference between apparent demand and real demand. And real demand is that end user demand. And I think China is the number one importer of oil, on LNG. I don't think they're just going to start buying when they see that end user need. They're going to start buying already now. So, and especially in Q1. So which one drives more? It's, I would still put my money probably on China because it's going to be a little bit chaotic here when it's driven in countries with multiple politicians instead of just one guy in charge in China. So that's a clearer mandate in terms of what things are going, but it absolutely can happen.
And that's a great point, Nadia, as well. There's so many cooks spoiling the broth here in Europe. It's not just one person in charge, and they're driving a lot of this uncertainty as well. And if you think you got these storage targets, they don't take into account where the market could be at that time. Of course, we know we want to get them filled up in the summer, but the fact they're putting these targets on in January, February, March, I don't know what they do in those offices, to be honest, but it definitely needs to improve. And if you've got this single voice, so to speak, or someone with a bit more clarity leading it, we'd have a bit more clarity on our end as well. So.
And after all, there's obviously the question about prices. I mean, which goes very much to what you both are saying. And my question to you both, again, and also to you, Ryan, in terms of power, is how long can industry and governments sustain importing at these prices or generating at these prices? I mean, we were subsidizing European countries have some sort of subsidy program for prices for more consumers at more risk. But how long is this sustainable? Are I can't imagine we're going to keep doing this forever. And the fact of the matter is, prices are going to be high, markets are going to be tight at least till 2025 when we get more LNG capacity come online. So. Yeah, the question is how long can European industry or governments or it's households sustain these high price environment? Nadia, you want to take the first?
Ryan would want to start.
I was going to allow Ryan to speak then. Sorry, because Nadia and I've been speaking for a while, so that's why I was silent.
Exactly. If you want to jump in, Ryan.
Let's start with power, Ryan.
Yeah, sure. I mean, on the power side of things, indeed, it's a complex picture, right? So we know that all the factors we've talked about have led to this huge increase in power prices, sustained increase in power prices this year. In response to that, member states have implemented a raft of measures to support end users, and those are targeted differently in different markets. They're structured differently in different markets. So everything from one-off payments to power consumers. It's also the case for gas. So, distinguishing between the two fuels, to fixing increases in tariffs. So the French government, for example, fixed limited tariff increases. And we've also seen the German government introduce something like a freeze on 80% of your consumption from the prior year, leaving that remaining 20% to the market. So there's just such a variety of those kinds of measures. And the bill is adding up, right? I mean, there are figures out there in the order of 600, 700 billion euros across all European markets to provide this kind of support. So, I mean, there's a couple of implications there. One implication is, so directly to respond to your question, how long can consumers sustain these kinds of prices? Well, if they're getting some kind of subsidy or shielding of those prices from the government, then I guess they can continue to do that, right? They will benefit from those kinds of packages if they're lucky enough to get those. But I guess the bigger question is a fiscal one, right? I mean, where is this money coming from? This is a stratospheric, again, amount of funding we're talking about, and it's something that's been very much left up to individual member states. So there were discussions between member states to come up with some kind of joint fund, using, for example, the joint issuance of debt by the European Commission, as was agreed during the pandemic, as a way to provide a sort of solidarity fund for member states to support end users. That didn't eventuate. Too much of a political hot potato. And at the moment now, we've seen countries go off in different directions. And so, at the moment, it's, we have some clarity in terms of some countries. So Germany has announced their package out until, I think, Q1 2024. Other member states not so lucky without those kinds of deep pockets. But it is very much dependent on those subsidies. I mean, that is really going to be a big driver of consumer behavior and user behavior over the coming 12 to 18 months.
I think if I can add to that, I think in terms of one question is, are these subsidies helping us deal with the demand question, right? Because obviously subsidies are not creating more supply when that is the fundamental problem. So I think that when Germany came out with its longer package, it was criticized very much because it was creating more of that moral hazard. So I think other countries haven't done it. It doesn't mean they won't do it. It's a bit of this wait and see what your neighbor's doing. On the other hand, when we look at who's paying for this, how are we paying for this? Well, the number one culprit has been windfall taxes on oil and gas producers, which has in Norway, been extended to renewables and seafood and things like that. And of course, Norway is in a very unique position as having been such a strong supplier of gas and having the most upside in this term, right? But now we are facing other macro forces, and that is a question of whether this will continue or not. Our country is going to do this every year. In Norway, it seems to be a little bit more sticky. Our view is that the outlook for oil and for gas structurally is very strong. For the next 5 years, we need to bring back investment. We're going to have stronger prices, and we have demand for supply. So in our view, the companies will do very well. So there will be money available to pay for these sorts of things. But I think that is something that is, not necessarily everyone agrees with across the line. The other point is that, in the support of Ukraine, there's been a lot of money spent on supporting them against this war, which, I would say personally, I hope will continue. But that is something that we'll have to see how long that lasts and how that is relatively speaking for each individual country. And for now, overall, the support seems to be there, but we'll see how that goes.
You, Wayne?
It was similar for the UK. I mean, we've seen these governmental stimulus packages. I think Rishi Sunak now is very keen to increase the windfall tax on the UK companies as well. So I think that will help. And also, I think we saw in the UK, I think last week, with temperatures below a certain level over 5 or 6 days, there's also another payment or initiative that was paid for by the government, where I think they transfer a certain amount of money into people's bank accounts to encourage them to turn the heating up to I think the required level is 18 degrees really is known as a required level to keep your sort of room warm. So, but that, I think the subsidy for energy customers in the UK domestic wise ends, I think, in April again, after I think Liz Truss, she was trying to extend it out longer. So I think these things are helping, but It's a bit easier, I think, in the position of Norway to have such thing because of the amount of gas and oil producing companies, the amount of revenues they have. Where in the UK it's slightly different, but I still see these packages will needed to continue, and will obviously influence end user behaviour. And of course, looking at industrials, they also need support with prices where they are, and not that UK industrial consumption isn't that large. I mean, it's fallen 50% over the last 12 to 18 months, but again, I think they'll need continued support as well, with prices remaining obviously at these elevated levels.
And it takes us to the heart of the matter, and we can't let go of this discussion without addressing market intervention. I mean, we've touched on it several times throughout the conversation, but there's windfall taxes, there's caps on gas for power, the so-called Iberian cap, and still to be determined the gas price cap, joint purchasing, creation of an LNG index. Anyway, there's a multi-array of market intervention either in the process, planned, still being discussed. And I think the most critical one is the cap on gas prices. The EU Commission says 275, as was mentioned earlier, but Greece and Italy, for example, say 160. How this actually comes down into some sort of agreement on this, and if we have anything to fall back on, it would be the oil cap negotiations, the global ones. But how do you view market intervention so far? Has it been harmful or helpful? Maybe Ryan, we can start with you.
Sure. Well, let me deal with the power side of that, and I'll leave the gas price cap to the colleagues on the call, because there's been some of the power market interventions have been now agreed. So the one that many of us are familiar with is the revenue cap on inframarginal or non-price setting power producers, which is, has been attempted to be unified at the European level, but in reality is a patchwork of individual member states implementing that revenue cap. Some member states got ahead of that curve. Greece and Italy were doing something like that even prior to or during this summer. And actually, you mentioned, Andres, the Iberian model, which is capping the price of gas for power generators. And, in hindsight, doesn't look so bad, right? I mean, that is a relatively elegant solution, which has resulted ultimately in power prices being reduced for Iberian consumers. Now, it's also meant there's been a massive increase in gas consumption, and hence Iberian Peninsula is importing gas from France and then exporting it back as power to France. So it's not exactly the solution necessarily that we should see rolled out across Europe, but it's just to say that there's been a plethora of these interventions, and everyone, including ourselves, everyone is trying to make sense of them, right? The most, I think, the critical element for anyone in the sector is, how long are these going to last for? Because, this is designed to be a short-term intervention. So at the European level, they agreed that something like a revenue cap for power producers should be in place only until around Q2 next year. But we've already seen in some markets, individual governments go ahead and propose something that extends beyond that, or at least introduce options to extend it. And the more you do that, then the more you introduce uncertainty, because, how do you know what your cash flows look like for a project financing or any kind of, investment activity, unless you know what that intervention is going to do to power prices. And, it's not a complete deal killer in the sense that, okay, no one was expecting revenues above 180 euros a megawatt hour prior to this year, but it just introduces uncertainty at a time when Europe needs to see an acceleration of investment into renewables. And so I think it's an important lesson for policymakers not to be too short-sighted in this. We really need to be playing the long game in terms of accelerating the transition towards, energy security.
And Nadia, how do you view all this market intervention? Helpful?
I would agree with Ryan that I think it's very dangerous in terms of a market signal. We have been Norway in particular, has been a very stable market, in terms of your expectations on laws and on what is allowed and how taxes work and things like that. And what looks like a small change for politicians is actually a huge change for the market, because it brings in questions of what will happen next. I think when we look on the gas side, to have this kind of big liquid market with all these hubs, you have 5 major hubs now in Europe. It's very exciting, actually, what has happened in the last 2 years. And when we compare it to the oil market, this is why oil and coal, why do we turn to oil and coal? It's because it's liquid, you can deliver into lots of markets, all of that kind of thing. And we're finally getting that in gas. And now we're introducing all these market uncertainties and peak prices and things like that, and what you can take where. And I think that creates more volatility, which is extremely bad for the players. We've had issues where, a big oil and gas producer with lots of infrastructure like Equinor, they're not so worried about some of this volatility. But when you have these individual companies and you're just a straight consumer and you've pre-bought, and now, your margin call is completely the other way, this is extremely problematic. So this is where the governments have to come in and help on that. So I think that there's been too much of this feeling, I think, since COVID, that governments need to do something, constantly be shown to do something. And we need to actually wait a little bit and calm down and just take it each step at a time before we rush with the next intervention.
Very good. Ryan and Wayne?
And I just think in terms of some of these decisions, I don't quite understand them, to be honest, especially when it comes to the price cap. And I think for me, it tells you that, like the first price cap, for example, they said, I think, up to 270 euros per megawatt hour. Now, the TTF front month contract had traded 4 times above that level in its history. And that was when, it was 26th of August, when the market actually peaked, when Gazprom stopped sending any flows via Nord Stream. And then I'm seeing after that, there's a just circulated this weekend. I was actually writing about it earlier, that they're talking about 220 euros per megawatt hour. So I was looking at my charts and thinking, okay, how many times has that been above that? And it was a similar thing. I think it was like 12 times. But most of the times it was above this new cap was, again, towards the end of August, when the market fears were at their highest. Now we're talking, I'm seeing now the latest headline is 160. But again, I just don't agree with these price caps. And you look at the 2 biggest opponents to price caps, the Netherlands and Germany. So I don't think it's going to happen. And also, I think not only that, I think there's also a precondition that it's 35 or so euros above the LNG price as well. So again, it wouldn't have been met even when prices were at their highest ever in August. That price cap wouldn't have kicked in. It also would mean as well, if they do kick it in, you lose liquidity. A lot of people go over the counter. You move away from the exchanges. It will distort the market. You've then got, overseas buyers have got an advantage over us in terms of they can just go above the price cap. For me, it's a non-starter. And it beggars belief as to who comes up with some of these schemes. And I think, again, the meeting, I think, is tomorrow. The can will get kicked down the road. They won't be able to agree. Then they'll have to try and get some more concessions. And it's dangerous. It's playing around with the market. And as the guys have both alluded to, we need some sort of balance or some sort of sensible recommendations. And perhaps they should speak to more people in the market, etc., than just come up with these ideas, especially, like I said, the 270. I'd love to know where that was derived and how they came up with that plan. I'm not a fan, as you can tell, of the EU price cap decision-making process.
And I think they also need to think about the medium-term message. It's not only about the short term, especially if Russia isn't coming back, which it probably isn't, not to the level it was in our view. What is the signal? We are so dependent on America to really invest in the infrastructure to give us the gas. And if we are introducing all these kind of caps, the Americans do not like that at all. And so that is, I think, the very dangerous thing. And yes, we have all these renewables coming, but if we're not in the net zero World Economic Outlook of the IEA, which means 2028, we see peak demand, which we at Pareto do not see at all. It's more like 2036, 2038 at best. How are we going to prevent numerous cyclical crises like this one in that 10 to 12-year gap? That is what we're trying to focus on. And that is what the EU politicians need to focus on.
Yeah. Stop kicking the can down the road.
I do hope that among our listeners, we have a few officials listening to some of these messages and some notes being taken. Let me go quickly to some of the questions we've received, some of them more complex than others, about demand destruction. One of the questions we have is whether it's structural demand destruction. In other words, considering our high price environment for at least until 2025, 2026, should we expect that demand destruction to be permanent? Is this gas demand that we're losing, or is it temporary?
I think I can start with that. Looking at your guys' faces, I think part of it is cyclical. I would say like 15 to 20% of that is cyclical. Opposite. I mean, I would say that 15 to 20% of it is sticky. The rest of it is cyclical. So we would expect it to come back, and that is especially driven by the consumer side. That is the most sticky. I think where we are, in general, this feeds into our view on China. We've had supply chain disruptions, which has been explained on the renewable side by Ryan. That once this all eases up, yes, that helps things in general across the board. But it's still going to be more expensive. We do not buy into this IEA view that energy prices forever are going to be high, that this, the era of cheap energy prices is over. We do not believe that. It's cyclical. It will go up. It will go down. We will have an oversupply again. But right now, when we look at gas, it looks undersupplied basically for the next 20 years. So that is where we need massive investment, and then we will have that kind of seasonality.
And a specific question, either to Nadia or Wayne. Will China receive more piped natural gas from Russia, so less LNG? Will that loosen up some of our balance in Europe?
In terms of China, could it?
Will China receive more Russian pipe supply enough so that it can actually ease the LNG market tightness to the benefit of Europe?
Well, I think you've got the Power of Siberia 2. Power of Siberia 1's already ramping up, and you've got the Power of Siberia 2 coming online, which would obviously increase supply. But in the short term, I don't think it's going to make any material difference on how this winter will play out. But longer term, yes. And of course, don't forget the fields that we used to supply the European market are very separate to what supplies the Chinese market. And I think we estimated it would take a good, up to 10 years to fully transfer those volumes that were going into Europe, into China at a significant loss as well, if you look at the price difference as well. So.
And this is where, just to add, I would also say that, there's an assumption that the Power of Siberia 2 wouldn't really happen. Our view is that I think China will do it.
Yes.
They are focused on oversupply in everything. They're the biggest renewables investor. They're the biggest in everything because they see this crisis we have. So I think it will completely happen. How much they will use that gas, that is a different question, but they're in a great position because they'll be the only buyer.
Exactly.
So that is, then they are the price setter.
It's a brave new world for sure. But we're running. We ran out of time already. We were having we're going to have to cut it short. I thank you so much to our panelists. It has been a pleasure, certainly for me. Your insights were much appreciated. And to our audience, thank you for tuning in and for your questions. And we wish you very happy holidays from Montel, and we hope to see you very soon. Thank you all.
Thank you.
Thank you very much.
Bye-bye.